Alright, good day everyone. This is NTT DC REIT first half FY2526 financial update dated 12 November 2025. Right, we look at their first set of results since IPO. Right, therefore their first half results are comparing against their adjusted IPO forecast lah. Right, so revenue is up 1.8%, MPI is up 1.7%. Distributable income is up 3.3%. Okay, there's a lot of adjustments made, I think, because of the fact that the REIT is new. I don't think there's anything sinister behind it, right? So I'm not going to worry too much about the annotations here lah, the number 1 and number 2, right? You can read the bottom here yourself if you wish to. Right, portfolio lease is rose 0.8 percentage points, all right, to 95.1%. Positive pricing trend, 5% overall rental revision, right? I think a good amount of this is actually baked into the contract lah. Okay, so this is, I think, for including the baked-in part as well as the new renewals, right? So this is the renewal part, all right, and the occupancy is now ahead of when it was in IPO, which was 94.3%. Right now it's 95.1%. Right, rental revision 5.1%, I think is alright. Okay, leverage ratio is low at 32.5%. So interest coverage ratio is therefore high. Right, this is even better than MIT, which is one of the highest interest coverage ratio around. Right, NAV is 97 cents, which is, I believe, currently the current price right now. Right, so it's roughly trading at NAV. Right, we look at this. This is the prospectus from the IPO, right? So this is an older document, right? I just wanted to show you some background of this REIT, right? So if you look at the REIT, basically their customers are broken down into two sets, right? The co-location sort and the hyperscalers, right? So hyperscalers are like the big companies, like for example, Amazon, Google, Microsoft, and I think Tesla, right? So the hyperscalers, right, and co-location, the difference is that hyperscalers tend to take up more space and over a longer term, therefore they demand cheaper rent, right? So normally when they get hyperscalers, the rent is more or less fixed over the longer scale, as I'll try and show you later. Right, the co-location, they say, is diversification, right? Typically they can charge higher price because they are smaller, right? And they tend to be attracted to the hyperscalers, according to what I read somewhere in the document, right? So that's the difference between co-location and hyperscalers, right? Hyperscalers are bigger, more stable, less likely to go bankrupt, more likely than not no issue with paying rent. Co-location, on the other hand, may have a bit higher risk, but they have shorter lease and you can raise their rent faster because they are small. You can negotiate better terms on the entity side, right? So yeah, then they say here, the hyperscalers attract co-location customers in the facilities. I'm like, okay, that's what they said, right? So we have a look at their where their rent come from. All right, you can see it's very concentrated into a few companies, right? So this Fortune 500 US automotive company, I believe, is Tesla. All right, I don't think there's any very big automotive company that requires data centers, but you can see Tesla is very big, 31.5% of the base rent of this whole REIT. So it's very, very concentrated, right? And then this one is also not small, it's 9.3%, 6.6%, right? So any of these, if they should pull out or go bankrupt, which is unlikely, more likely they pull out, right? There may be a lot of fluctuations in the REIT's rental income. And for example, if you have 31.5% rent from this company, right, Tesla, let's say it's Tesla, I'm not very sure also, but my best guess is Tesla, right? The hit to DPU won't just be 31.5%, it'll be more because there's still fixed costs, right? You still have to pay for the for example, the interest on the loans you took out to buy that data center, right? And of course, the operational costs. So the hit to DPU will be greater than 31.5%. But later on, I'll explain to you why I don't think this Tesla percentage is a big issue, right? And at least that's my perspective, right? So anyway, this is the supposed good part. So the contract is fixed escalations of 3.3% on average for 74.6% of the contracts, and 3% with CPI escalations, link escalation. So what I think this means is that even if the contracts are very long, let's say for like 5-6 years, right, every year there's escalation of some 3+%, right, which is good. That means it builds in the rental increase over time. and you should expect DPU to grow, all else being equal. Okay, so what are the things in the prospectus, right? So when they launch the gearing's on the lower side lah. Here the IPO they say 35% leverage, but if you look at the slide earlier, I think it's lower already, right? So it's 32.5%. So they actually have a bit more space to do acquisitions. So this is the amount of money they have to do acquisitions, right? 272 million and 450 million. This is to 50%. All right. So this is to 50%. Sorry. Right. So they're 450 million to 50%, and to 45% they have 272 million. So they have 6 properties currently. This one will be enough for 7 property according to the size of the data centers that they have lah. Right. This one maybe can squeeze 2 lah if it's a bit smaller. Right. So the debt maturities and the rest I don't think is very important. So there are 6 properties. Where are the properties? Important to know, right? They are in US, right? US got 4, so it is 2/3, right? So 2/3 in US, so they are more heavily concentrated in US than MIT, all right? But they say they are in North Virginia, which is supposed to be the largest market in the world. What I interpret this to be is that it's the largest market demand in the world lah, right? I don't really see how else they want to define this, right? So and then North California is 8th largest market in the US, right? So they have 3 here. They have 3 in North California and 1 in Virginia, right? Then they have 1 in Vienna, which is Europe, and 1 in Singapore, right? I suspect this one is included purely for debt purposes, because later on when you see their debt, right, is disproportionately tilted towards Vienna, probably because Europe has lower interest rates, right? So the debt may shift in the future lah. I don't know, we have to see, right? So the pie is more or less split into 6 parts, right? Because 6 data centers, roughly they're all equal size, right? So 3 in North California, 1 in Virginia, 1 in Europe, Vienna, actually that's Austria, 1 in Singapore, which we know high demand, so not too worried about Singapore, right? So we look at the financial statement. I think we talked about it, so not going to talk too much about everything, except that the revenue is up due to high revenue from co-location and power services at Austria and Singapore assets, as well as increased tenant fit-out revenue arising from total customization works requested by tenants in the US assets, right? So it looks like everything is positive here. MPI is driven by higher order operating income, right? Particularly from US assets, favorable as FX, right? Which may not be always the case. We can't really hope that this will always be the case, mitigated by higher property expenses, which is, I think, sort of expected when you have higher usage, right? So I'm okay with this one rising in line with this one, right? Distributable income 3.3% above adjusted IPO forecast. Again, a decent result, right? We want to check whether they are doing better than expected or not, right? So the DPU is obviously higher than projected, all right? So 3.3% higher, which we like to see. All right. Just to note that this is, I think this is partial DPU. It's not DPU for 1/2, because frankly, if you look at the IPO prospectus, I think the IPO at $1 with a 7.5% dividend projection. All right. But this dividend projection is reliant on a lot of assumptions. Okay. So I explain to you the assumptions. Number one is 100% payout ratio. All right. So they have to pay out everything. Then also management fees are paid in units. That means to say, if the management will pay in cash instead, right, then this 7.5% yield is not possible. It's going to drop, right? Also, if they pay out 90% payout ratio, which I think is more sustainable over the long run, again, this 7.5% is not sustainable, right? Also, I will explain to you the possible risks. They seem to have tax concern laws at all 3 places, right? So number one, I think in US, US, Austria, and Singapore, right, they are all applying for some form of tax exemptions, right? And they actually, as far as I can understand it, right, have not confirmed that they have gotten the tax exemptions. But I think generally they are quite confident in getting the tax exemptions, right? So if the tax exemptions don't work out, then again this 7.5 year is under threat, right? So this 7.5 year is best case scenario. You cannot think of it as the so-called expected yield, all right? So of course, I think there's high probability that they will get their associate tax exemptions, but given that the US is now so uncertain under Trump, there is some possibility that Trump may change the laws even if they get tax exemptions, right? And also, there's still that small probability that the tax exemptions will work out. So these are things you have to be concerned about with this REIT, right? And of course, management fees paid total in units, 100%, this 100%. This will cause dilution over the long run. So second and third year, I think you cannot expect 7.5% unless the REIT actually performs above the amount that is distributed, right? So here I'm not sure why their liabilities increased by 9.6%, right? Not really explained as I can find that out, right? But generally, NAV has increased to 0.97. I think this is a good thing, so I won't worry too much about this, right? Yeah, you can see here, looks like Euro only 1/6 of the portfolio, but the debt is 45%, right? So clearly they are putting the Austria building in, right, just to get cheap money, as far as I can tell, right? Occupancy, yeah, it's slightly higher, right? IPO, it was 94.3, now it's 95.1. The way they calculate occupancy is a bit different. It's something to do with the amount of usage rather than the building. Yeah, so this is something a bit strange. I've not read about this before, right? But later I'll try and show you where I saw that, right? I cannot remember where I found it. But anyway, occupancy is a bit strange. They count by usage, right? So this is Virginia, right? This is Virginia. Yeah, this is Virginia, right? So you can see 98% usage. This is California, right? 95% usage, so generally quite good in general. Then we look at Austria, right, which is 91% usage, right? So this one is a bit strange because as I read later, you see Austria has very low supply, right? So I'm a bit surprised this is quite weak, right? Singapore also a bit disappointing. Supposedly supposed to be very high demand. I'm quite sure Singapore has very high demand again. It's below 95% also, right? So these are a little bit concerning. I think this one is all three assets in California, if I'm not mistaken. Later there's a breakdown, right? So let's look at this one. This one we talked about it already. So yeah, we talked about the fact that this loss, right? Now it's lower now. So this is the updated one. So we should look at this. It wasn't 31%, it's 30%. Right, so this 30% loss will hurt dividend more than 30%. So you just take note of this. Right, because the fixed cost will remain. We talked about this. Right, this one is another big one. The middle one, I think we don't have to worry too much about because it looks like it's a sponsor. Sponsor is not going to harm the REIT, most likely, unless they really get in trouble, in which case there are bigger concerns. Right. So yeah, don't have too much to say about this. This is why I think Tesla is not such a big problem. If you look at Tesla, it's 30%, right? 30% of the monthly base rate. If you look at the lease expiry, none of this is 30%, right? Which means the 30% must be here. Which means that if the top customer is here, the top customer is locked in for a very long period, right? And I don't think Tesla is going bankrupt anytime soon. The worry is more that they leave the REIT and find their own data center or something like that. But I think the risk is not very high, right? Given that, assuming what I say is true, right? This one I won't talk about it too much. I think we talk about, their leverage is relatively low, but I tell you that you have to think in terms of, from what the management say, right, that there are likely to be rights issues ahead, right? So ICR is good, right? No need to talk about this. You see the cost of debt is not cheap, even with the European side, right? But this can be thought of as a good thing. So its interest rates drop, right? The cost of debt may go down and the DPU may go up, right? So maybe a good thing that the cost of debt is a little bit higher, that it's likely that their refinancing will benefit them. Although if you look at their refinancing, it's not a lot, right? So here and here. Sorry, this is lease. This lease, not lease. Refinancing is earlier in front, right? Is quite controlled also. I think this is refinancing. Sorry, no, this lease. I'll look at refinancing later, right? Sorry. What was I saying? Yeah, right. I was talking about the ideas behind what they want to do, right? So they want to acquire more assets from the sponsor, and I do think that if they don't want gearing to pick up, right, they are likely to do rights issue, right? So this one, if you hold on to it, you must be careful and have money set aside for rights issues, right? So Singapore rental revision, they expect to be good, nothing new, right? nothing much to say here. Yeah, so this is I just look at the vacancy lah, because vacancy I think is a sign of demand. So North California, you can see 3.5% vacancy, which I think is okay, quite high demand. Virginia is very low, 0.3% vacancy. Yeah, so I think that explains why just now Virginia the occupancy is very high, right? So Vienna, the occupancy is getting higher, although they say actually the occupancy here is supposed to be quite high. You see, historically driven by retail demand, but now seeing global cloud providers and large enterprises looking into come into the there's some missing word here. So so this one, the occupancy is a bit low in Vienna. So I guess, and you can see vacancy is a bit higher at 5.3%, which sort of explains why they are a bit low lah, right? You can see it in front. The Vienna sub-market is only at 91.4%. So I think they are roughly in line with the market sentiment there. Singapore, you can see very low lah. This is Singapore, right? So no need to say this one likely to have good rental revisions, but Singapore is only 1/6 of the portfolio. Just note that. Sponsor owns 25% of the REIT. Generally, it's a good thing, but I think they cannot increase their holding anymore. So that's their limit. So one thing you can think about is the sponsor can't step in to buy if the price drop, right? So if something happens, the price drop for this type of small REIT can be very bad, because if you look at the way the REIT is run, is very focused on quite a few customers, right? The third largest player is 10%, right? So if you lose 10% of income, quite bad. DPU should drop by more than 10%, right? The sponsor is very large, right? So they have a very strong pipeline of DC REITs to sell to the REIT. Okay, just that you want to take the opportunity to buy in or not, right? So you can see the occupancy here, which you see roughly is all around $200 million to $300 million, right? So not say very big data centers, right? You can see all freehold, but I think all in US, so freehold is nothing new lah. Freehold is just, I mean, the land there is so much, right? Vienna, I'm not sure about the conditions, but Singapore only 30 years. Singapore is not freehold, right? Of course, they can extend after August 2040, right? You can see the occupancy is a bit low at these two, California and Vienna, right? So this is a bit worrying because if you look at MIT, right, this is, I think, the start of the downfall of MIT. That when you look at these figures over here, it's a sign that the data center is not in high demand, even though there's high demand in the region, right? You get what I'm trying to say? So you can see that Vienna's the occupancy is the vacancy is 5%, but they have more than 5% vacancy, right? So I think this asset is probably not that high in demand. That's my opinion, right? So the rest I won't talk about it. DBS, I think, has a $1.20 DCF take profit, so they assume a couple of things like 5% growth. What else did they say? 5% growth. I think interest rates going down, so and so forth, right? So this was, I think, before this report came out. It was 4th November, I believe, right? So DBS report was a little bit outdated, so I don't think there's a more updated one, right? So that's all I have for NTT DC REIT, right? There's no advice to buy or sell. Personally, I would not buy at the current price. I want to have some margin of safety, so at least 10%, and then I'll look at what's going on, then I'll consider whether I want to buy or not. Right, so thanks for listening. Do give me a like if you like my analysis. Right, thank you, and